Hi, I'm Rick Kaler. Thanks for joining me. The first week of January 2016, I talked with a retired man in need of some retirement planning. He had a portfolio of about $1 million invested in money market and certificates of deposit. His Social Security income was about $25,000 a year, and his lifestyle spending was around $60,000 a year. This meant that he really needed to withdraw 35,000 or about 3.5% from his portfolio to make up the difference. A 3.5% withdrawal rate is very realistic to provide a relatively high probability of never running out of money. For a diversified portfolio, which I would define as, say, 40% bonds and 60% global stocks, real estate, commodities, investment strategies, things like this, my research would indicate that a long-term return of around 5% would be reasonable to expect. I wish I could tell you that this man invested his $1 million in January, but he elected to keep his money in cash. Why? He said, "I have a bad feeling about the market. I think it's about to crash." Well, guess what? He was right. Global stock markets did crash, actually quite spectacularly. By the second week of February, a portfolio of global stocks was down almost 12%. Had he invested in a diversified portfolio such that I would have recommended in January, he would have been down 3%. With only a third of his portfolio in global stocks, the rest would have been in other investments that collectively did a lot better than equities. Still, by keeping his money in cash, he was $30,000 richer than if he had followed my advice. Now, the story would have a very happy ending had he invested in mid-February when the global market started back up. Unfortunately, he still had a bad feeling that the upturn wouldn't last and the market would drift even lower. So he waited. Fast forward to August of 2016, global stock markets rose spectacularly from mid-February and were now up around 8% for the year. Had he invested in January, the 3% loss he would have seen in February would have become a 7% gain. His retirement portfolio would be up $70,000. Instead, he had earned 0.2% on his cash, a $2,000 gain. His decision not to invest has cost him $68,000 so far. He still has a bad feeling about investing because the U.S. stock market is now at an all-time high. He reasons it will eventually crash, and he will get in then. While he is sad to have missed out on earning $68,000, he's convinced his bad feeling will prove him right in the long run. And maybe it will. The evidence and the research, however, is not on his side. When it comes to investing, it's crucial to be aware of our feelings, yet acting on the stories we make up around those feelings can be detrimental and costly. Here are some of the stories this investor made up. If the stock market goes down, everything in my portfolio will go down equally. Not true. Investing when the market is high is a guarantee of losing money. Not true. Value is based on earnings per share of stock as well as the price of a share. Based on the price to earnings ratio history, there could be plenty of room for the stock market to continue to rise. Another one was, when markets go down, I'll be able to invest at or near the bottom. This is rarely the case. Plus, he had already been unable to do this in February, so why should he expect to be able to do so in the future? Feelings of fear, panic, desperation, greed, and remorse around investing are normal. Successful investing really requires letting those feelings pass and taking actions based on sound logic, probabilities, and historical research. Thanks for listening.